So on behalf of the Tools for Life Learning Center at Loudoun Habitat for Humanity, I'd like to welcome you to today's virtual workshop. Our presentation today is called How Much House Can I Afford? Which we know is a question lots of us would like answered. So my name is Amanda Bollig. I'm the Tools for Life Learning Center manager, but I also oversee the home repair program at Loudoun Habitat for Humanity. We are so excited to have you joining us today for the presentation. So with that, we're going to go ahead and jump right in with our discussion points. So we're going to talk about the key factors involved in the loan approval process. We'll also break down for you what's involved in that mortgage payment. And then we're going to give you some general guidelines that you might be able to use to help you determine the house that you can afford. So joining us today, you can see her on screen, is Mary Krueger, the branch manager at Movement Mortgage. And we know Mary because she is part of our Family Services Committee, and she helps teach some of our Homebuyer Club classes, as well as doing some financial one-on-one mentoring to our homebuyers. So we are super excited to have Mary joining us again for another Learning Center workshop, and we know she's got some great information for us. So Mary, thank you for joining us. If you have questions for Mary during the course of her presentation, you can put them in the chat box, but we're not going to answer them till the end of her presentation. We'll let her get through all the content, and then we'll have some time for answering questions. So with that, Mary, I'm going to go ahead and pass it off to you to start off the presentation.
Great. Thank you, Amanda. I'm happy to be here, and thanks for having me. Again, it's truly a topic near and dear to my heart. So as Amanda shared, we are going to look at the factors of the pre-approval and get a better understanding of your credit history, how your employee status interacts and affects the overall process, taking a look at the qualifying income, existing debts and how they play into the overall process, and the down payment and what those resources are, and again, the impact it has on the overall pre-approval. Next slide. So how much can I afford? Lenders in general will use your credit report and debt to income ratio to determine the loan amount you qualify for. The debt to income ratio is typically the anticipated total housing payment plus your existing debt payments divided by your gross monthly income. And we're going to dig into that a little bit deeper later on in the presentation. But certain loan programs offer different qualifying guidelines for expanded debt to income ratios, lower down payments, and lower loan amounts. So it's not just black and white, everything fits in a box, or every person fits in a box. There's a lot of programs and a lot of different scenarios, and it's like you're putting a puzzle together. Go ahead, next slide. So that's why we are here today. As I mentioned, everybody is unique. Everybody has a different story, different backgrounds, different financial impacts to their overall situation. So those puzzle pieces we tend to refer to as the 4 C's of underwriting. And these are the 4 categories that we're going to be looking at. Go ahead, next slide. So collateral. This is one of the biggest pieces, if you will. It ultimately determines the value of your property, or making sure that you're not going to overpay for your property. But this is one piece that you don't have any control over. You will be expected to pay for an appraisal up front, but that collateral is the collateral value that the lender or bank has at the end of the day to secure against your note and the monies that they're going to lend. So that value of the property can vary based on location, size of the home, condition of the home, whether, what the rebuilding costs might be, and the cost of similar homes. So they also take a look at, similar geographic areas. They don't want to go to different zip codes. You could have the same exact builder build the same exact house, number of bedrooms, number of bathrooms, but in 2 different zip codes could be a completely different value. So there's a lot of these factors that do go into it. So once you are under contract, that is something that is done up front, for which then, we can determine as to making sure that that value comes in at least equal to your contract price or greater than. If it comes in less, you're back to the drawing board, potentially with renegotiating with the seller. But overall, there's a protection in place to ensure that you're ultimately not going to be overpaying for this property. And thereafter, that's what you rely on for the appreciation, and that's what your investment is ultimately going to be, the equity that you start building based on that future value, which is really exciting to see, in one of the largest investments that you'll be making in your lifetime. Next slide. So credit, this is the first step. Ultimately, we need to know your credit and whether or not any work is going to need to be done. So with the credit, we would pull, and a lender, when you meet with a lender and do a full application, we pull a mortgage credit report. Oftentimes there's confusion because so many of us today have Credit Karma or various identity theft or fraud alerts, different things set up by your credit card companies or your bank that might give you some indication of a score, but that's not to be confused with the mortgage reporting score. That's more of a consideration of a consumer credit score and how banks choose to charge you rates on your credit cards based on those scores. It is those Credit Karma scores, or I see a lot of different names of them these days, not to discount them, because it is a good tool to know, setting a baseline and know that if anything, you want to continue to see those kind of scores go up. It's just to set you up with the fact that it may not be as your mortgage score may not be as high as that consumer score. But the overall credit and how it impacts your ultimate situation with the different types of loans that you're going to have, it does play a big part. Go ahead and go to the next slide. So this is how lenders use your credit scores. Basically, the higher the credit score, the lower the risk overall. Credit scoring really has proven to be a good model to determine that what's the likelihood that one is going to repay their debt. If people, whether it's just being lazy, forgetful, missing a payment within the last 12 months or 30 days, it can have a much more negative impact on your score. So really paying attention to that data is important. But when you have lower risk, you get better pricing overall. It allows the lenders to make an objective decision based on the credit data and truly see what is being reported, and if there's anything that's reporting on a credit report that wasn't necessarily disclosed in the initial application. And then the Tri-Merge credit report is pulling from 3 different bureaus: TransUnion, Equifax, and Experian. So a credit report will combine data from all 3 of these bureaus and repositories. And then we take the middle score to rank the qualifying score for any individual. So that middle score, not the average, but the middle of the 3 scores is going to be used to set the parameters going forward. What's also good to know is at this time, once we do that initial credit, if it's not satisfactory to meet the needs of whatever program one might be looking at, we have the ability to do further analysis to determine a roadmap of what needs to happen to get a score to a certain level. And then we have the ability to rescore and fix it, if you will, if it's fixable. And the timeline, is it fixable within 5 to 7 days, or is it fixable in 3-6 months? So we have that ability to do a timeline. I had a recent situation where there was a collection account that showed, a small balance due, but when I ran the model, her score wasn't quite at the target score that we needed. And we ran the model and it had been paid off. And a couple of days later, we actually do a soft pull to see that it's no longer reporting. And now, sure enough, we pull the new report and the scores are better and acceptable, and not a whole lot of work needed to happen there. So it is important, and one of the first things we'll tackle when we first meet in an official loan application. Go ahead, next slide. Now, the other big factor I mentioned was the interest rate and the impact that it could have. So the higher the interest rate, the higher your overall payment is. So you want to try to get the best interest rate possible. And when you're locking in, the market changes every day. The market's changed dramatically in the last 2 months. And so what we were quoting 60 days ago isn't necessarily what we have today. But when the time comes and you know that you are under contract, that's usually the first sign that you're able to be locking in on the interest rate. You want to get a commitment in writing, ensure that you're locking for a long enough period of time to cover your closing date, and then making sure you get, whether there is a commitment fee or a lock-in fee required up front. to protect it. Sometimes longer periods of a rate lock might require an upfront fee because the lender essentially is starting to incur a cost on hedging that loan on the secondary market. So go ahead, next slide. Knowing your ratios and determining your loan affordability. This is the biggest piece that really drives your overall qualifications and the affordability factor. So the housing expense or front end ratio, that is a percent of your gross income devoted, like no more than 30% is a general rule of thumb. No more than 30% of your gross income should be devoted to your mortgage, total mortgage payment. And then the debt ratio or debt to income ratio, which is also known as the back end ratio, is a percent of gross income devoted to the mortgage as well, but it takes into consideration the overall debt. All right, let's go ahead and go on to the next slide. So the beginning factor of this is the capacity. The capacity is the third C that we were referencing here, and that is the driving force of your income, okay? Determining your gross income, making sure you have income stability and likelihood to continue at least 3 years. There's a lot of sources of income that could be, whether it's a primary job, secondary job, part-time jobs, alimony, child support, notes receivable, Social Security, so many variables of acceptable sources of income. But when it comes down to it, we need to make sure we do have the likelihood of it continuing for at least 3 years. And we usually do need to demonstrate a 2-year history of having earned this source of income. Go ahead and go to the next. The lender will review your assets as well. So the cash, okay, the cash is required overall, whether you have cash left over in reserves after closing, whether you actually need cash into the transaction, and the various acceptable sources of cash. One, your own personal savings. That's going to be documented by your bank statements. You might have 401k, retirement accounts. Those also will be documented by quarterly, potentially monthly statements. And then gifts are acceptable sources of funds. But going back to borrowing against a retirement account is okay, but also gifts from family members. But it's really important to fully disclose all intention upfront with your lender, disclose all of the possible resources so you can avoid any potential hurdles in that, in this process, because this is probably one of the stickiest and most sensitive areas of cash. If I get 2 months of bank statements and I see a bunch of large deposits, I'm going to have to question them and what the sources are. Are they acceptable sources? A lot of times we have direct deposits, so those are clearly documented in an employer direct deposit, but the overall other types of deposits may not be from acceptable sources. We might not be able to use them from the overall qualifying, cash that's needed. And then you might have access to down payment and closing cost assistance through the county, through various programs, whether it's Habitat or the state of Virginia. There's a lot of different programs out there that can help really minimize your out-of-pocket expense. And that's why, again, it's so important to start upfront and meeting with the lender, getting a full application, and starting to tackle each of these pieces of the puzzle. 3 of them can be done through that pre-approval process, so that everything's laid out and there's a clear roadmap to the finish line, which is successful closing at the end of the day. Go ahead and go to the next slide. So understanding the types of mortgages, I'm not going to go into too much detail here, but this in and of itself is could be a whole nother class, but the various mortgage loans are backed by various government entities. So a conventional loan is backed by Fannie Mae and Freddie Mac, household names you probably have heard on the news, Fannie and Freddie. Those are what we consider conventional loans, could have as little as 3% down payment. An FHA loan is the Federal Housing Administration. That's also known by HUD. It's backed by the Housing and Urban Development. That's 3.5% typical down payment. VA loans, the Veterans Administration, if one is served in the military, they might have eligibility for which they could use. And oftentimes it's 100% financing or zero money down. USDA which is also known as rural development, is another 100% type financing program, 0% down. We've got to add VHDA, the Virginia Housing Programs, again, various state and local government programs. And depending on where you're listening from, each state might have its own, type of programs. And again, that's where you might see the biggest assistance based on income eligibility for down payment assistance, possibly grants and various factors. Again, which is why it's important to talk to a lender that has an idea of a lot of programs or is able to offer a lot of programs. And if you check with various lenders and to see what, banks and credit unions might offer something different than traditional lenders. The other factors then that go along with that is the interest rate. It ultimately impacts your qualifications, and likely first-time home buyers are getting 30-year fixed rates, but you can look at different terms, 15 years, 20 years. The lower the amortization period, the higher the payment is going to be. An adjustable rate mortgage is one that might have a lower start rate for a period of time, but it's going to adjust, and you want to be careful with that. And the risks associated with an adjustable rate mortgage could be a very good tool, but it also could lead to much higher payments down the road, depending on the market. So again, it's one of those things you look at potentially a few different programs that you might be interested in, but understanding how these all work. The jumbo loan is where we get into much higher loan amounts, over like 825. I forget over the high balance, but when we get outside of the conventional, regular or high balance loans, you get into private investors. And all of these loan programs have the impact of various qualifying ratios, which we're going to talk about in just a minute. But again, like I said in the beginning, that it's not cookie cutter, it's not black and white. Everybody's going to be a little different and might have different qualifications overall, but we want to set you up for some general, rule of thumb. It's oftentimes that I might qualify you for a higher payment at the end of the day than what you want out of your own personal budget. So let's jump into that. Let's go to the next slide. So what does your mortgage payment include? Okay, your mortgage payment consists of at least 4 standard amounts. It's also known as the PITI. The P is for principal, which is basically your loan amount. The I is the interest rate at such time that you get locked in. That will drive the ultimate initial factors of your payment of the P and I. The principal and interest is the biggest portion. Principal, as you make a monthly payment, you're going to pay down a portion to principal, but the bank is then going to be getting the interest portion. Taxes, the T, is for the property taxes, whether it's just the county, you might be in a small town, or also have city and town taxes. So you have to look at all of these housing expenses when we are getting down to the overall piece of the puzzle, this determining what your payment is and what that affordability is. The insurance is the homeowner's insurance. That's something that you will be required to take out that doesn't protect the house from burning down, but if it happens, if something tragic happens, that insurance is going to help cover and protect the lender and you from potentially rebuilding or covering the expense to repair. So a lot of different factors that will go into that. Let's go ahead and go to the next slide. This breaks it down a little bit more in detail, as we talked about with regards to, again, that original balance on the monies that we're lending up front, that principal. Every month you're making a mortgage payment, and a portion of that mortgage payment is being applied to the principal. A portion of that money is going towards the interest. That's the income ultimately that these banks or lenders have. And then there's an escrow account set up for your taxes and your insurance. And it's kind of a nice savings plan because we will set aside the taxes you're going to be paying upfront and then monthly based on the prorated annual premiums of the taxes and the insurance, so that the following due dates, whether it's semi-annually or once a year, when those bills come due, it's going to be paid out of your personal escrow account from the lender. Now, other factors that you might have here, if you have less than 20% down, you're going to likely have mortgage insurance, the PMI and MIP. It depends on the type of loan. Private mortgage insurance is typically referred to on a conventional loan, and then the MIP or mortgage insurance premium on the government loans. But any of those loan programs we talked about will have some kind of a mortgage insurance built in some way, be it in the monthly or single premium financed. But it ultimately does fall into the total monthly payment. So it's PITI plus plus, because you have the private mortgage insurance, and then you also have likely a homeowners association or condo fee. A fourth element that, depending on the property type, even a single family dwelling could be in a planned unit development for which there is a homeowners association. And that is going to be part of your housing expense that we look at for qualifying, even though that's one element that you're going to be paying directly to the entity, whoever's responsible for the association. Let's go to the last slide here. So now we're going to get down to the nitty gritty of this. What are these ratios that we're talking about, and how ultimately is this affordability going to be made? You know, your credit score, the score in and of itself isn't necessarily part of the affordability, other than the credit report provides the monthly debt that we're going to be using in analyzing that back ratio, that debt ratio. And when we talked about the capacity and the income, that gross monthly income that we're going to be able to use to qualify you, that's going to be the big factor. So let's start with your gross monthly income. If you take 28% of that, that is, again, the general rule of thumb. That number in and of itself could be your personal budget or the threshold for which the lender will not go over. That monthly payment cannot exceed 28% of your total gross income. We might go up to 35%. That's generally a good range. 35% of your gross monthly income should not exceed your housing expense. So I think it's a good rule of thumb to use 28 to 35% of your qualifying gross monthly income. And then your back ratio, as you see here, when you take that proposed housing expense that we've determined how to calculate or figure, plus the monthly recurring debt obligations, that's going to be divided by the gross monthly income, the same figure, but you get a little more tolerance there, obviously, because you have monthly debt obligations. And we would say 36 to 45% is a good rule of thumb. So at a quick analysis, I might say, let's take 40% of your gross monthly income, subtract out the car payment, the credit cards, the student loans, and whatever's left is what's left for your housing expense. There's a few different tricks on kind of determining what the lender is likely going to be qualifying you or able to qualify you for. But as we go through those motions and I come back and let you know, well, this is your maximum qualifying payment. That payment backs into a loan amount based on the market rate at the time. It's ultimately the payment that really drives your affordability and ultimate qualification. So this is really important to understand, because a lot of times people want to know, how much house can I afford? And that all depends. It depends on the down payment you have available, or down payment assistance, or gift resources. So what cash do you have available? And then what is the capacity? What is your income? And because interest rates change daily, you know, that interest rate to loan amount calculation to determine your principal and interest may change often. So that ultimately that moving target is the sales price at the end of the day. But what we know firmly is that payment, that total payment. And as you go to sit down and plan your personal budget, household spending plan, whatever the case might be, when you've done the math, depending on what your rent is today, you might have a different target, a different budget. So just because I come back and say, yes, you can qualify or get approved for this payment, don't feel like that's something you have to take, because you have your personal situation that lends into the ultimate deciding factor of what you know, because we don't take into a lot of consideration some of the things that you know are in your personal budget. It's pretty much everything that's going to be coming off of a credit report. Again, your installment loans and your revolving credit, and then potentially, you know, other special circumstances, but not like your utilities and your insurances and cell phone bill and other usages, you know, weekly expenses and weekly and monthly expenses. We're not taking that into consideration. Next slide, please. So I think the overall after covering that, I'm going to turn it back over to Amanda.
Yes, thank you for that wonderful presentation. I know I certainly learned a lot. So just to kind of recap some of what we learned from Mary and think about these things and see if you might have some questions for her. So we've discussed, and she's really taught us that the amount that you get qualified for from the lender may not necessarily be how much you feel like you can afford. So do that spending plan, figure out what percentage of your budget you really feel like you can dedicate to that housing cost. But you could try to follow one of these rules like the 28-36 rule, or use some of these percentages that Mary gave you and use those as a guiding principle for determining what you think you can actually afford when you're purchasing a home. And then lastly, we talked a little bit about the down payment. We've talked a little bit how the credit score plays into things. So as you're preparing to purchase a home, continue to save so you have that larger down payment to put down, and also keep working on paying down some of your debts, because that's going to be important too and does play into that overall approval process. So with that, we're going to move over into question and answer time. So if you have questions for Mary, you can put them in the chat box now. But just to get started, Mary, I had a question for you. Thought you might be able to answer. Should I go and get pre-approval from multiple lenders?
It's a great question. It's oftentimes, folks, various websites and things will suggest it's not so much getting fully pre-approved by a variety of lenders, but certainly talking to various lenders and banks to get an idea of the typical types of programs that they might have to offer. So it's, for second opinions, anything that we do, and we're taking, this is undertaking the largest single investment that you will be making. Just like going to a doctor, if you have a tragic, health issue or something that isn't, you don't want to make a quick decision on, and you would go and seek advice from others. It's worth, understanding what that process is to more likely compare different programs and interest rates that are being offered. Just to clarify, you shouldn't have to go through a full pre-approval per se to be able to really zero in and identify what lenders are going to be able to offer, different packages or different programs, whether one lender can do all the programs that you might be interested in, or somebody else might just have more niche products, but it sounds really good because it's grants and other, associated factors that they can help you with in that home buying process.
Very good. We have one more question that just came in the chat box, and then we'll wrap it up. So we talked about the credit report being an important piece in this process. If I want to work on my credit, because I know I might be looking to purchase a house soon, where can I go to get my credit report besides Credit Karma?
So, and that's a good question as well. And, a lot of people might go to the free annual credit report.com. It doesn't give you credit scores, but it does give you more likely to see what's going on in the mortgage reporting, what's being reported. But I strongly encourage you to go to a direct lender, because ultimately, if getting a mortgage is your goal, going to a direct lender is going to give you that mortgage report and have the tools that are available to potentially analyze and help. Maybe still have to refer you to a housing counselor, which out in the community of various counties have access to, but at least you'd be on the right path of knowing how that mortgage report score is comparing to what you might be getting yourself on the Credit Karma. But myfico.com is another place where you would actually be able to get the score with, but it does cost money. Most lenders don't charge anything on the initial analysis, or even like free consultations and even pre-approval. So that's something certainly to ask various lenders as you look around as to whether there is any kind of a charge or obligation. We are offering free services and volunteering basically up until we go to closing with somebody. So there's a lot of information we have to share at no expense to you.
Well, that's wonderful to hear. So that was the last question we had. So we're going to go ahead and wrap things up. So thank you, Mary, for joining us today. And I want to thank all of our guests for also joining us. We're very excited for you, and we hope that you learned a lot of great information that you can now apply in your life. If you're interested about more information about Loudoun Habitat for Humanity or the Tools for Life Learning Center, you can check out our website, loudounhabitat.org. And we do have a lot of our recorded workshops up on our website. And this one will be recorded and put up next week that you can go back and re-listen to some of Mary's great points. If you want to join us for another workshop, we do have another one coming up on April 15th. And we are going to be discussing volunteering in Loudoun County. So we'd love you to join us for that. You can check out the registration on our website, and we hope that you all will join us again soon. Thank you.
Thanks for having me.